Quick reminder, check out the 40% off coupon code linked down below and the 2 events I have coming up, including one free rally this weekend on Saturday in San Francisco and one in Los Angeles the week thereafter. Hey everyone, me Kevin here. Tomorrow CPI data comes out. I know many of you do not like CPI data because you don't trust it, and that's fine. It is still a market moving catalyst though. So let's take a look at what the expectations are. First things first, and this is a very, very quick recap. You have to understand this before I give you projections and what to expect for tomorrow. Very important that the way CPI is calculated is such that when we compare year over year, we're looking into a hole in this case. This is the hole of the pandemic. Everything closes down, prices fall, so businesses can still sell something. Prices of goods and services, everything plummeted. The exception of certain things like meat and cereal because of, supply issues. But anyway, what we're going to do, just to see how this might work annually, is we might see, right now we're growing maybe at about 1.6 points over here. Let's just go with 1.4 in CPI data. And so the way you could calculate this is you could grab a little calculator, and you could take our current CPI reading of a 266.8 from April 2021 here. You can see that. Add about 1.4 to get what maybe May of 2021 might look like. And then divide by this hole right here. See, 255. If you didn't divide from the hole, the percentage you're about to get would obviously be a lot smaller. So because we're dividing by this hole over here, which is actually lower than it was last month, the inflation reading is going to be even higher. So I wouldn't be surprised to see a headline number like 4.8% as a year-over-year inflation, which is going to be a very scary number because it's almost 5%, and I think there will be a lot of clickbait and a lot of news headlines over this inflation number, whatever it is. But it's actually not the number that matters. Now, keep in mind, that's not to discredit the fact that there is inflation presently, but what's more important is not that there is inflation presently and that year over year we've had 4 or 5% inflation. That's not what matters right now. What actually matters is the month-over-month data, and this is what you're going to want to pay attention to. So last month, we got the report from April. We got April's inflation readings, which compared to March. We had a 0.8% increase in prices from March to April. And a lot of that was driven by cars. Used cars shot up 4.6% month over month. That's intense. The annual reading was like 9.6% as a bump for car prices. So car prices are going to have a potential renewed impact on this month over month figure, but hopefully because prices have gone up, hopefully they're starting to stabilize. And if they're starting to stabilize on the month over month, our month over month data should not be as bad as it was last month. Having month over month readings at 0.8% is really, really scary because if you annualize that, you're actually seeing inflation at over 9% per year, 9.6%. So you really want to try to put some of these details aside and focus on what specifically matters. And that is that if we do get a flattening in car prices, and we know we're comparing to the whole of last year, we're not going to look at the annualized data. Instead, we're just going to go month over month. The current expectation for a month over month reading is 0.4%, about half as high as it was last month. Here's the catalyst portion. What happens if this meets expectations, beats, or comes in lower? Well, if it meets expectations, I don't expect the market to move much. The market will say, okay, good, we have half as much as the month-over-month inflation reading last month. This is pretty good. Market continues to operate the way it does. A fall in month-over-month data. So, for example, let's say month-over-month inflation comes in and it's 0.3%, 0.2%, or in a crazy way, watch it goes negative potentially. Maybe because some aspects had just risen too much and now they're coming down a little bit again in price, like used cars or whatever. We'll see. If that's the case, 0.3 is pretty close to 0.4, so probably not going to see much there. But if we get a reading at 0.1, 0.2, or even negative, that's going to be very, very bullish because it sends a signal that we might be willing to delay tapering, that more money getting injected into the economy is not creating month-over-month inflation. Maybe we'll see a delay in the interest rate increase by the Federal Reserve. And this potentially also sends the signal that we have much more capacity to print if we wanted to. If we needed to print more, if we needed to stimulate more, we could. But in other words, this month-over-month figure coming in low would be very, very bullish for the broader market. because we don't want to see inflation. We don't want to feel like we're getting hyperinflation and that we're going to have a market crash because the Fed is going to jack up rates substantially to try to combat this. And so what companies is this generally good for? Well, a fall in the amount of inflation, or at least a good fall below in expectations, would, in my opinion, be good for tech, consumer discretionary, and healthcare. Probably not so good for banking, financials, and industrials. So usually companies with good financials now or working with loans, not so good. You want to see those higher interest rates. You don't mind inflation as much because you're producing now. Companies with more earnings in the future, like online consumer discretionary, like Etsy, or tech, like Tesla, Apple, Microsoft, or healthcare with projects that won't actually be available, or new potential drugs that won't be available for a long period of time. Inflation hurts. So a lower reading would be very, very good for these sectors, and that's what we're hoping for. However, if we get a reading above, probably not much impact again if we're at like 0.5, maybe 0.6. But if we go over like 0.8 or 0.9, and it's not just used cars, but all of a sudden it's everything inflating on a month-over-month basis, I wouldn't be shocked to see a nice, quick 1.5% pullback in the S&P quickly, and tech may be selling off 2 to 3% pretty quickly if inflation comes in higher. And then depending on the magnitude at which how high it comes in, we'll know how long a potential sell-off lasts and how deep it'll go. So these are definitely things that I would be cautious of, especially if you're trading. This has the potential of being a large catalyst event for many different stocks and many different companies. So I would pay attention to this. Be prepared. Remember what you're looking for. I will be live at 5:30 in the morning covering it, so you're welcome to be here with me. We'll look at it. But what would be very prudent for you to do now is not only use the coupon code down below to get 40% off on the amazing programs linked below, including my stock buy and sell alerts in my Stocks and Psychology Money group, but also write on a post-it note right now, expectation, 0.4 month over month. Very, very, very important number there. And maybe even start charting your strategy like, oh, well, I've got options in this. Do I sell or buy more? Do I buy the dip or not? Think about those things. All right, folks, there you have it. Thank you very much for watching. We'll see you in the next one.